Question 1. Normal practice question. A policyholder in Hawaii has purchased a term life insurance policy with a renewable term option. After the initial term of 10 years, the policyholder wants to renew the policy. Which of the following statements is correct about renewing the term life policy? A. The policyholder will need to provide new evidence of insurability before the renewal is approved. B. The policyholder can renew the policy at the same premium rate as the initial term. C. The renewal will be automatic without the need for new evidence of insurability, but the premium will increase. D. The policy cannot be renewed after the term ends, and a new policy must be purchased. Answer: C. The renewal will be automatic without the need for new evidence of insurability, but the premium will increase. Explanation: under a renewable term life insurance policy, the policyholder can renew the policy at the end of the term without providing new evidence of insurability. However, the premium will increase based on the policyholder's age at the time of renewal. This reflects the increased risk due to aging. Hawaii's insurance regulations ensure policyholders understand the premium increases, but allow for renewal to meet changing needs without underwriting again. Options A and D are incorrect because renewable term policies specifically allow renewal without new evidence of insurability. Option B is incorrect because premiums always rise upon renewal due to age-related risk factors. Question 2. Scenario-based question. Mr. Nakamura, a 40-year-old business owner, has a term life insurance policy with a convertible option. 5 years into his 10-year term, he decides he wants permanent life insurance coverage. What should Mr. Nakamura do to convert his term policy, and which of the following is true about his conversion option? A. Mr. Nakamura must undergo a medical exam to prove insurability before converting the policy to whole life. B. Mr. Nakamura can convert his policy to permanent life insurance without any additional medical underwriting, but his premium will be adjusted based on his current age. C. Mr. Nakamura will need to pay a fee to convert his policy, but the premium will stay the same as the term policy. D. Mr. Nakamura cannot convert his term policy until the end of the 10-year term. Answer: B. Mr. Nakamura can convert his policy to permanent life insurance without any additional medical underwriting, but his premium will be adjusted based on his current age. Explanation: in Hawaii, as with most states, term life insurance policies with a conversion option allow the policyholder to convert the term policy to permanent policies such as whole life or universal life without undergoing additional medical underwriting. This is a key feature of convertible term insurance. The new premium will be based on the policyholder's age at the time of conversion, but no new medical exams are required. This provides flexibility for policyholders like Mr. Nakamura who want to switch to permanent coverage as their needs change. Option A is incorrect because no medical exam is required. Option C is wrong because while the premium will increase, there is typically no separate fee for the conversion itself. Option D is incorrect because Mr. Nakamura does not have to wait until the end of the term to convert his policy. Question 3. Normal practice question. In Hawaii, which of the following is considered adverse selection in the context of life insurance? A. Insuring individuals who are healthy and have low risk of death. B. Insuring a large group of people under a group life insurance policy. C. Insuring individuals who apply for coverage because they have a known health condition that increases their risk of death. D. Insuring individuals at random without any regard to health conditions or risk. Answer: C. Insuring individuals who apply for coverage because they have a known health condition that increases their risk of death. Explanation: adverse selection occurs when individuals with higher risk, such as those with known health conditions, are more likely to apply for or continue their life insurance policies, which can lead to higher than expected payouts for insurers. Insurers attempt to manage this risk through underwriting and premium adjustments. In Hawaii, as elsewhere, life insurance companies use risk assessments to prevent adverse selection, ensuring that premiums are sufficient to cover the risk. Option A describes a low-risk scenario and is not adverse selection. Option B involves group life insurance, which spreads risk across many individuals, reducing the impact of adverse selection. Option D would not typically occur, as insurers use underwriting to assess risk factors. Question 4. Normal practice question. Which of the following statements is true regarding the waiver of premium rider in a term life insurance policy in Hawaii? A. The waiver of premium rider waives the premium payments only if the policyholder becomes terminally ill. B. The waiver of premium rider waives all future premiums if the policyholder becomes totally disabled for a certain period of time. C. The waiver of premium rider waives the premium payments only if the policyholder loses their job. D. The waiver of premium rider only applies to permanent life insurance policies, not term life insurance. Answer: B. The waiver of premium rider waives all future premiums if the policyholder becomes totally disabled for a certain period of time. Explanation: the waiver of premium rider ensures that if the policyholder becomes totally disabled and meets the waiting period, usually 6 months, the insurer will waive future premium payments. This rider can be attached to term life insurance policies, ensuring the policy remains in force even if the policyholder cannot pay premiums due to disability. Option A is incorrect, as the rider is generally tied to disability, not terminal illness. Option C is incorrect because job loss is not covered. Option D is wrong because the waiver of premium rider can be added to both term and permanent policies. Question 5. Normal practice question. In Hawaii, if a term life insurance policyholder allows the policy to lapse due to non-payment of premiums, what non-forfeiture option might be available to the policyholder? A. Extended term insurance. B. Reduced paid-up insurance. C. Return of premiums paid. D. No non-forfeiture options are available for term life insurance. Answer: D. No non-forfeiture options are available for term life insurance. Explanation: non-forfeiture options, such as extended term insurance and reduced paid-up insurance, are only available for permanent life insurance policies. Term life insurance policies, by nature, do not accumulate cash value, so there are no non-forfeiture options available if the policy lapses. Option A and B are applicable to permanent insurance policies like whole life. Option C might only apply in cases where a return of premium rider is added, which is uncommon and only applies if that specific rider was purchased. Question 6. Scenario-based question. MS Takahashi, a 35-year-old graphic designer, purchases a 20-year term life insurance policy to cover her mortgage. 5 years into the policy, she is diagnosed with a chronic illness and is considering adding an accelerated death benefit rider to her policy. Which of the following is true about this rider? A. The accelerated death benefit rider will provide her with a portion of the death benefit while she is alive, but the total death benefit will be reduced by that amount when she dies. B. The accelerated death benefit rider will pay her the full death benefit and no further payout will be made upon her death. C. The accelerated death benefit rider will waive her premiums, but no payout will be made during her lifetime. D. The accelerated death benefit rider is not available for term life insurance policies in Hawaii. Answer A. The accelerated death benefit rider will provide her with a portion of the death benefit while she is alive, but the total death benefit will be reduced by that amount when she dies. Explanation: the accelerated death benefit rider allows a policyholder to receive part of the death benefit early if they are diagnosed with a terminal or serious chronic illness. The payout reduces the amount paid to beneficiaries upon death. In Hawaii, this rider is commonly available for both term and permanent policies, making option D incorrect. Option B is incorrect because only a portion of the death benefit is paid early, not the full amount. Option C confuses the accelerated death benefit rider with a waiver of premium rider. Question 7. Normal practice question. In Hawaii, when replacing an existing term life insurance policy, what is one of the agent's legal responsibilities during the replacement process? A. The agent must provide the client with a disclosure about potential surrender charges on the new policy. B. The agent is required to notify the existing insurer about the replacement. C. The agent must explain the benefits and drawbacks of both the old and new policies and ensure the replacement is in the policyholder's best interest. D. The agent has no specific legal responsibilities during the replacement process. Answer C. The agent must explain the benefits and drawbacks of both the old and new policies and ensure the replacement is in the policyholder's best interest. Explanation: in Hawaii, as in most states, agents have a fiduciary responsibility to act in the policyholder's best interest during a replacement process. This includes providing full disclosure about the pros and cons of replacing the existing policy, ensuring the policyholder is making an informed decision. The agent must also ensure that the replacement aligns with the client's needs and financial situation. Option A is incorrect because surrender charges do not typically apply to term life policies. Option B is incorrect because the agent's primary duty is to the policyholder, not the insurer. Option D is incorrect because agents have clear legal responsibilities during replacement. Question 8. Normal practice question. Which of the following is a common reason for an insurer in Hawaii to deny a death benefit claim on a term life insurance policy during the contestability period? A. The policyholder was involved in illegal activities at the time of death. B. The policyholder died of natural causes. C. The policyholder did not designate a beneficiary. D. The policyholder's medical history was misrepresented on the application. Answer D. The policyholder's medical history was misrepresented on the application explanation during the contestability period, typically 2 years. Insurers can investigate and deny a claim if material misrepresentations remain on the application, such as lying about medical conditions. Option D is the most common reason for claim denial during this period. Option A could potentially lead to a denial, but only if the illegal activities are specifically excluded in the policy. Option B is irrelevant as death by natural causes is covered. Option C would not lead to denial but could result in the death benefit being paid to the estate if no beneficiary is named. Question 9. Scenario-based question. Mr. Alvarez, a Hawaii resident, is considering a 1035 exchange to replace his existing term life insurance policy with a new permanent life policy. Which of the following is true about a 1035 exchange in this scenario? A 1035 exchange allows Mr. Alvarez to replace his term policy with a permanent one without incurring any tax liability on the gain from the term policy. B. A 1035 exchange is not allowed for replacing term life insurance with permanent life insurance. C. Mr. Alvarez will need to pay income tax on any gains from his term policy when conducting a 1035 exchange. D. A 1035 exchange is only available for life insurance policies that have accumulated cash value. Answer D. A 1035 exchange is only available for life insurance policies that have accumulated cash value. Explanation. A 1035 exchange is a tax-free method of replacing one life insurance policy with another, but it is only available for policies that have cash value, such as whole life or universal life insurance. Since term life insurance does not accumulate cash value, Mr. Alvarez cannot use a 1035 exchange to switch from term to permanent insurance. Option A is incorrect because term life policies don't have cash value to transfer. Option B is misleading, as a 1035 exchange is allowed for permanent to permanent policy replacements. Option C is incorrect, as a properly executed 1035 exchange avoids immediate taxation on gains. Question 10. Normal practice question. Under Hawaii law, a term life insurance policy must include which of the following provisions? A. Cash value accumulation. B. Non-forfeiture options. C. Incontestability clause. D. Conversion privilege for all policyholders. Answer C. Incontestability clause. Explanation. Hawaii law requires that life insurance policies, including term life policies, contain an incontestability clause, which means that after a certain period, usually 2 years, the insurer cannot void the policy due to misrepresentations on the application except in cases of fraud. Options A and B are incorrect because term life policies do not accumulate cash value and do not have non-forfeiture options. Option D is incorrect because while many term policies offer conversion privileges, it is not mandatory for all policies. Question 11. Normal practice question. Which of the following is NOT a requirement for reinstating a lapsed term life insurance policy in Hawaii? A. Paying all overdue premiums, including interest. B. Providing evidence of insurability. C. Completing a new policy application. D. Reinstating the policy within a specific time period, typically within 5 years. Answer C. Completing a new policy application. Explanation. To reinstate a lapsed term life insurance policy, the policyholder is typically required to pay all overdue premiums with interest, provide evidence of insurability, and request reinstatement within a specified period, usually 5 years. Completing a new policy application is NOT required, as reinstatement involves continuing the original policy terms, not starting a new policy. Question 12. Normal practice question. Which of the following is true regarding group term life insurance in Hawaii? A. Group term life insurance policies do not require medical underwriting for any participants. B. Group term life insurance coverage is typically portable, allowing employees to keep the coverage when changing employers. C. Group term life insurance premiums paid by the employer for coverage over $50,000 are considered taxable income for the employee. D. Group term life insurance policies cannot be converted to individual policies. Answer C. Group term life insurance premiums paid by the employer for coverage over $50,000 are considered taxable income for the employee. Explanation. In Hawaii, employer-paid group term life insurance premiums for coverage over $50,000 are considered taxable income to the employee, known as imputed income. Option A is incorrect because medical underwriting may be required for coverage beyond a guaranteed issue limit. Option B is incorrect, as group life insurance is generally not portable unless there is a conversion option. Option D is incorrect because most group term life policies offer conversion to individual policies when employment ends. Question 13. Scenario-based question. Mr. Yamamoto purchased a term life insurance policy in Hawaii with a face value of $200,000. He added a return of premium rider to the policy. If Mr. Yamamoto does not pass away during the term of the policy, what will happen when the policy term ends? A. Mr. Yamamoto will receive the full face value of the policy, $200,000. B. Mr. Yamamoto will receive a refund of the premiums he paid during the policy term. C. Mr. Yamamoto will receive a partial refund of the premiums minus administrative fees. D. Mr. Yamamoto will not receive any payout since the death benefit was not triggered. Answer: B. Mr. Yamamoto will receive a refund of the premiums he paid during the policy term. Explanation: a return of premium rider provides that if the insured survives the term of the policy, all premiums paid during the term will be refunded. The face value of the policy is not paid out, as that only applies in case of the policyholder's death. Option C is incorrect because the rider typically refunds the full amount of premiums. Option D is incorrect because the return of premium rider ensures for payout at the end of the term even if the death benefit is not triggered. Question 14. Normal practice question. Which of the following is true about the conversion privilege in Hawaii term life insurance policies? A. Conversion allows a policyholder to switch to a different term policy with a higher face value. B. Conversion allows the policyholder to change from a term policy to a permanent policy without providing evidence of insurability. C. Conversion allows the policyholder to extend the term of the policy without an increase in premiums. D. Conversion allows the policyholder to switch to a permanent policy only if they have experienced a significant life event. Answer: B. Conversion allows the policyholder to change from a term policy to a permanent policy without providing evidence of insurability. Explanation: the conversion privilege allows a term life insurance policyholder to convert the policy to a permanent life insurance policy without undergoing medical underwriting, making it easier to continue coverage even if health conditions have changed. Options A and D are incorrect because conversion specifically applies to switching from term to permanent policies. Option C is incorrect, as premiums usually increase when converting to a permanent policy. Question 15. Normal practice question. In Hawaii, if a policyholder misses a premium payment, how long is the grace period before the term life insurance policy lapses? A. 10 days. B. 30 days. C. 60 days. D. 90 days. Answer: B. 30 days. Explanation: the grace period for life insurance policies in Hawaii, including term life policies, is typically 30 days. During this time, the policyholder can make the overdue payment without losing coverage. If payment is not made within the grace period, the policy will lapse. Options A, C, and D are incorrect because the standard grace period for term life insurance in Hawaii is 30 days. Question 16. Scenario-based question. MS. Koi purchases a 10-year term life insurance policy in Hawaii with a decreasing death benefit. What is the likely purpose of this policy? A. MS. Koi wants to cover her mortgage, which decreases over time. B. MS. Koi wants to provide level protection for her family throughout the policy term. C. MS. Koi expects her income to increase over time and wants to match her death benefit accordingly. D. MS. Koi is looking for a policy that builds cash value over time. Answer: AMS. Koi wants to cover her mortgage, which decreases over time. Explanation: a decreasing term life insurance policy is often used to cover debts like a mortgage, which decrease over time. The death benefit decreases as the debt is paid off, ensuring that Koi's family can cover any remaining mortgage payments if she passes away. Option B is incorrect because a decreasing death benefit does not provide level protection. Option C is incorrect because increasing income is not typically matched with a decreasing death benefit policy. Option D is incorrect because term policies, including decreasing term, do not build cash value. Question 17. Normal practice question. Which of the following is true about the incontestability clause in Hawaii term life insurance policies? A. The insurer can contest the policy at any time a fraud is discovered. B. The incontestability period typically lasts 2 years from the policy's issue date. C. The insurer can contest the policy if the policyholder misses premium payments. D. The incontestability clause only applies to policies that have been in force for more than 5 years. Answer: B. The incontestability period typically lasts 2 years from the policy's issue date. Explanation: The incontestability clause is a provision in Hawaii term life insurance policies that prevents the insurer from contesting or voiding the policy after it has been in force for 2 years except in cases of fraud. Option A is incorrect because the clause limits contestability after 2 years even if errors were made on the application except fraud. Option C is incorrect because missing premiums would lead to policy lapse, not contestability. Option D is incorrect because the standard incontestability period is 2 years, not 5. Question 18. Normal practice question. In Hawaii, an individual purchases a term life insurance policy with a level premium. This means A. The premium increases each year as the policyholder gets older. B. The premium stays the same for the entire term of the policy. C. The premium decreases each year as the death benefit decreases. D. The premium stays the same for the first 5 years, then increases. Answer B. The premium stays the same for the entire term of the policy. Explanation: a level premium means that the policyholder will pay the same premium throughout the entire term of the policy. This is common in term life insurance policies providing predictable payments. Option A describes an increasing premium policy, which is not the case here. Option C refers to a decreasing term policy, not one with a level premium. Option D describes a graded premium structure, not a level premium. Question 19. Scenario-based question. Mr. Lee is reviewing a term life insurance policy that offers a living benefits rider. If he becomes critically ill and needs to use this rider, what is likely to happen? A. Mr. Lee will receive a portion of the death benefit while he is still alive. B. Mr. Lee's premium payments will be waived for the duration of his illness. C. Mr. Lee will receive a refund of all premiums paid to date. D. Mr. Lee will receive a new policy with increased death benefits. Answer A. Mr. Lee will receive a portion of the death benefit while he is still alive. Explanation: a living benefits rider or accelerated death benefit rider allows the policyholder to access a portion of the death benefit if diagnosed with a terminal or critical illness. This can help cover medical or other expenses during the policyholder's lifetime. Option B refers to a waiver of premium rider. Option C is incorrect because living benefits provide access to the death benefit, not a premium refund. Option D is incorrect because the rider does not increase the death benefit. Question 20. Normal practice question. Which of the following is not true about waiver of premium riders in term life insurance policies in Hawaii? A. The waiver of premium rider allows the policyholder to skip premium payments if they become totally disabled. B. The waiver of premium rider usually requires the policyholder to be disabled for a specified period, often 6 months, before benefits apply. C. The waiver of premium rider refunds all premiums paid before the rider takes effect. D. The waiver of premium rider keeps the policy in force without the policyholder having to make payments during the disability. Answer C. The waiver of premium rider refunds all premiums paid before the rider takes effect. Explanation: the waiver of premium rider in a term life insurance policy allows the policyholder to stop paying premiums if they become totally disabled. The rider typically requires a waiting period during which the policyholder must remain disabled before the waiver kicks in, usually 6 months. The premiums are waived going forward but are not refunded for the period before the rider takes effect, making option C incorrect. Question 21. Normal practice question. Which of the following best describes the concept of adverse selection in insurance? A. The tendency of individuals with higher risk to seek insurance more than those with low risk. B. The process by which insurance companies evaluate the risk of applicants. C. The requirement that policyholders provide a full medical history when applying for coverage. D. The principle that all policyholders pay the same premium regardless of their risk level. Answer A. The tendency of individuals with higher risk to seek insurance more than those with low risk. Explanation: adverse selection occurs when individuals who are more likely to file claims are more inclined to purchase insurance, while healthier individuals may opt out. This imbalance can lead to increased costs for insurers and is a key consideration in underwriting and risk assessment. Question 22. Scenario-based question. Mr. Thompson is considering purchasing a term life insurance policy. He is particularly interested in ensuring that his policy can be converted to a permanent policy in the future without evidence of insurability. Which type of rider should Mr. Thompson look for in his term life policy? A. Return of premium rider. B. Renewable term rider. C. Convertible term rider. D. Accidental death benefit rider. Answer C. Convertible term rider. Explanation: A convertible term rider allows policyholders to convert their term life insurance into a permanent life insurance policy without undergoing a medical exam or providing evidence of insurability. This feature is beneficial for those who may want lifelong coverage in the future. Question 23. Normal practice question. What is the primary purpose of the incontestability clause in a life insurance policy? A. To allow the insurer to review claims after 2 years. B. To prevent the insurer from denying a claim based on misrepresentation after a specified period. C. To guarantee that premiums will not increase for the life of the policy. D. To ensure that beneficiaries receive the death benefit within 30 days of the insured's death. Answer. B. To prevent the insurer from denying a claim based on misrepresentation after a specified period. Explanation. The incontestability clause typically stipulates that after a policy has been in force for a certain period, often 2 years, the insurer cannot contest the validity of the policy based on misrepresentation provided the premiums have been paid. This protects policyholders and their beneficiaries. Question 24. Normal practice question. Which of the following statements about group life insurance is true? A. Group life insurance typically requires individual underwriting for each member. B. The master policyholder is responsible for issuing individual certificates to group members. C. Group life insurance policies usually do not provide coverage for dependents. D. All members of a group must take a medical exam to be covered under the policy. Answer. B. The master policyholder is responsible for issuing individual certificates to group members. Explanation. In group life insurance, the employer or group sponsor holds the master policy and is responsible for providing individual certificates to covered members. Unlike individual policies, group policies often do not require individual underwriting, allowing for simplified coverage and eligibility. Question 25. Normal practice question. What is a key factor that influences the premium rates for term life insurance? A. The insured's credit score. B. The insured's health status at the time of policy issue. C. The age of the beneficiary. D. The type of policy being purchased. Answer. B. The insured's health status at the time of policy issue. Explanation. Premium rates for term life insurance are primarily influenced by the insured's health status along with other factors like age and lifestyle. Healthier individuals generally qualify for lower premiums due to reduced risk of mortality. Question 26. Normal practice question. What does a return of premium rider do in a term life insurance policy? A. It provides a refund of premiums paid if the insured survives the term of the policy. B. It increases the death benefit in case of the insured's premature death. C. It guarantees a loan against the policy's cash value. D. It allows the policyholder to convert the term policy to a whole life policy. Answer A. It provides a refund of premiums paid if the insured survives the term of the policy. Explanation. A return of premium rider refunds the premiums paid if the insured outlives the term of the policy, providing a savings element that can make term insurance more appealing. This rider often results in higher premiums compared to standard term policies without this option. Question 27. Normal practice question. In Hawaii, what is the maximum time period for which a term life insurance policy can be renewed without evidence of insurability? A. 5 years. B. 10 years. C. The policy term. D. Indefinitely as long as premiums are paid. Answer. C. The policy term. Explanation. Many term life insurance policies allow for renewal without evidence of insurability, typically for the length of the term specified in the contract. However, after this period, the insured may be required to provide evidence of insurability to renew coverage. Question 28. Normal practice question. What are non-forfeiture options in a life insurance policy? A. Benefits that are paid out only if the insured dies within a specified time. B. Options available to a policyholder to prevent the loss of coverage after the policy lapses. C. Provisions that allow policyholders to increase their coverage without a medical exam. D. Features that guarantee a payout in the event of a suicide. Answer. B. Options available to a policyholder to prevent the loss of coverage after the policy lapses. Explanation. Non-forfeiture options refer to benefits that allow policyholders to retain some value or benefits from a policy even after they stop paying premiums. Common non-forfeiture options include cash surrender values or reduced paid-up insurance. Question 29. Normal practice question. Which of the following best describes the human life value approach to determining life insurance needs? A. It calculates the present value of future earnings of the insured. B. It estimates the total debts and liabilities of the insured. C. It focuses on the emotional impact of the insured's death on beneficiaries. D. It considers only the insured's current savings and investments. Answer A. It calculates the present value of future earnings of the insured. Explanation: the human life value approach assesses life insurance needs by estimating the present value of future earnings that the insured would have contributed to their dependents. This approach provides a financial basis for determining adequate coverage to protect the family's financial future. Question 30. Normal practice question: which of the following is a characteristic of a level term life insurance policy? A. The premiums decrease over time as the insured ages. B. The death benefit remains constant throughout the policy term. C. The policy accumulates cash value over time. D. The coverage amount is tied to the insured's current income level. Answer: B. The death benefit remains constant throughout the policy term. Explanation: a level term life insurance policy provides a fixed death benefit that remains unchanged throughout the duration of the term. This feature allows policyholders to know exactly what their beneficiaries will receive in the event of their death, making it a popular choice for individuals seeking straightforward life insurance coverage.